Hi, and welcome back to the ghbond channel. We're here today on the banks of the mighty Mississippi River to revisit the famous Mark Twain saying, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't so." So, what do today's market participants believe that just ain't so? I think what they have believed is that this was going to be a fairly short-term correction, that it was bottoming, and that inflation was about to turn around. Well, as we can see, the crash is continuing, and I held it off a day. I was going to publish this video last night, but I wanted confirmation, and today we got what is the traditional confirmation of a bear market when you go down 20%. So why am I looking for a bear market? And what is a market thesis? Well, a market thesis is where we pick a direction based on an analog, which is a similar period in a similar time in the market. And I'm not doing this because I'm some great market forecaster. I'm doing it because we've had an uptrend for a very long time. It's been a major uptrend since the 2000 bear market completed. And it's time for another major correction. So we're going to start with the thesis that it's going to be similar in size to the 2000 analog. Already it seems to be going down faster than the 2000 analog. So let's take a look at why that's happening. And for that we turn to our favorite friend, ghbond. So you remember when you were a kid and you had the experience on the swing set. Somebody would be pushing you and you'd be kicking. Finally, you'd get high enough in the air where you'd feel slack in the chain and you'd fly up and become weightless. And then you start to free fall. And you can see the little girl there, that chain's got slack. She's up in the air and she's getting ready to free fall. That's kind of where we were with the stock market last Thanksgiving. We were coming up to the top and we were getting ready to free fall. At the same time, inflation was coming up, and our good buddy ghbond said, "Hey, inflation's here. We need to start increasing interest rates, and we need to reverse quantitative easing." So you can see ghbond with his hand, and he's ready to pop that hand on the girl's head and push her down even faster. So that's why I believe we're in a market crash situation, because we have the natural rhythm of the market, which was already bringing us down, coupled with ghbond, who thinks he's fighting inflation by increasing interest rates. Whether or not that's true remains to be seen. But for right now, we have a perfect confluence of forces with both a naturally falling market and the Fed trying to push the market lower at the same time. So how does the Fed push the market lower? One of the Fed actions is to raise the discount rate, and the discount rate is what you hear when the Fed's going up a quarter point, going up a half point. Maybe this month they'll do a half or 3/4, or maybe even 100 basis points, which is 1 full point on the interest rates. So what that does is largely respond to expectations that the market already has. You may have heard that the market has discounted the Fed actions. So the Fed talks a game first and gets the market to react, and then the Fed simply follows through on what the market already expects. Also notice that when interest rates go up, bonds go down. Now why would that be? Well, let's say I got a $100 bond, had a 4% interest rate. I thought that was great. 4% is a good rate nowadays. And a few months later, rates keep going up. Now rates are 5%. And I need cash, and I want to sell my bond to my neighbor. I say, "Hey, I got this 100 bond. It has a coupon rate of 4%. Will you buy it from me?" And my neighbor says, "Well, yeah, but that's a 4% bond. I can get 5%. So I'll buy it from you, but I'm not going to pay you 100. I'll pay you 92 for that bond." So that's why when interest rates go up, the old bonds that already exist get cheaper. Bonds go down. So whenever you're hearing people talk about, the interest rate market, you have to listen to the context. Because when they say things are going up or going down, you have to figure out if they're talking about the interest rate or if they're talking about the value of the instrument. Interest rates go up,
bonds go down. But interest rates are going up right now, and as the interest rates go up, stocks become less attractive. Because why speculate in the stock market when you can get fairly risk-free return from a bond? So that's why increases in interest rates overall, all things being equal, tend to cause lower stock prices. And so we've seen a little bit of that, but that's not the end of where we're headed. So let's look at the other action that the Fed takes. The other Fed action is reducing the balance sheet, aka quantitative tightening. Now, we all remember quantitative easing, and we just sort of figured that was the Fed taking wheelbarrows of money and dumping it into the system. What they actually do is they buy a couple things mainly, which is Treasury instruments and mortgage-backed securities. Now, you know we have a national debt, and we have to keep funding that, and to do that, we sell Treasury instruments. Now, normally we expect other countries to buy those, or some of our own people to buy those. But in the case of quantitative easing, the Fed just prints the money and buys them all by themselves. When the Fed buys the debt, what that does is it keeps the money that would have otherwise went into buying the debt out there in the system. That money is now available for investing in businesses, buying homes, whatever. Mortgage-backed securities, very similar. They buy the mortgage-backed securities, that puts a floor on interest rates for new homes, helps people like banks who want to go out and lend money to new home buyers, and they can take that mortgage and turn around and put it in a mortgage-backed security, and the Fed's a ready buyer. When we reverse that, when those packages of securities come due, the Fed doesn't renew them. The Fed doesn't keep buying Treasury instruments. In fact, they may sell some Treasury instruments. So instead of taking money and printing it and putting it into the system, they're taking money already in the system and they're removing it. So the combination of interest rates being higher and Fed pulling money out of the system sort of double down to make money less available for investing in stocks, and that helps stocks to go lower. So what else do we have in this equation? In addition to all those problems, we have obviously the crisis in Ukraine. The crisis in Ukraine is especially bad because it's made commodities go up, and because commodities are going up, in addition to the commodity prices increases we already had from the pandemic, now it makes inflation look really bad. And the Fed only knows one thing to do when inflation gets bad, and that's raise interest rates more. Meanwhile, we do not have a policy to increase our production or refinery capacity, and that is going to exacerbate higher fuel costs. If you think $5 is high, I don't think we've seen the end of it, because the world is going to need more and more fuel as years go by, and that's a situation that's not going to get better. So by us not taking the bull by the horns, even though we have new electric cars and wind turbines and solar, it's going to take 50 years for that stuff to catch up, because not only do we not have the electrical infrastructure for it, we don't have the materials. There's a number of things that are going to slow that whole thing down. So it's not going to happen nearly as fast as Al Gore would like it to. So meanwhile, we're going to need more and more fuel, and we're also going to need nuclear. We're going to need everything, all of the above. And the current administration isn't really chasing that yet, which means things are going to get worse, inflation's going to look worse, the Fed's going to keep tightening, and it becomes a vicious cycle. That's how bad it can get. And when it ends is when the Fed finally realizes that they're going to kill the goose in trying to save it, and they do the famous Fed flip-flop. But we're not counting on it anytime soon. Now, this is a slide from my original presentation, which again you can get a link to and check out all the details as what leads into the crash. This is about baby boomers. 30% have all their assets in the stock market. Can you imagine all those boomers out there that still own all their assets in stock? 52% of them have 70% or more in the stock market. So there's a lot of boomers out there with a lot of money in stocks. The problem with the boomers is they are rolling over to be more retired and less employed. An employed boomer is great. He's paying into all these social programs and he's putting money into the stock market. Once he retires, however, he's not so great because he's not putting so much money in those programs. He's drawing from them. And also, he's pulling money out of the stock market to live on. So that boomer situation, that huge chunk of the population, is a time bomb waiting to go off. What are we looking at in terms of this potential market crash? We're already in step one. Step one is when the traders panic. Traders are starting to realize, hey, this is not your average correction. Twice now, I've tried to rally, and every time I've ended up with a lower low. What does that sound like? And by the way, we're down 20% today officially. So this is officially bear market territory now. So traders, they're in the panic mode right now. The second step is the hodlers panic. You know the hodlers, hold on for dear life. The hodlers are easy to identify. You know what they say. Well, I'm down 40%, but I know what I own. I'm going to hang in there. I know the market's going to turn around. It always does. Well, yeah, it always does, but eventually it's going to drop low enough where the hodlers say, the hell with this. I was going to hodl, but I didn't sign up for this big of a drawdown, and they're going to sell off. The last people to sell off are going to be those boomers, those retirement accounts. We may or may not get a panic. We're so vulnerable because so many of the boomers have retired or are about to retire. And when they see that stock market selling off, there's going to be a head for the exits moment. If we reach that head for the exits moment and all the boomers try and get out of the market at once to save their retirement funds, that will be a day to remember. Because the market will crash very quickly and very forcefully and way beyond any level it should reasonably get to. Now, this isn't the crash where the U.S. economy implodes and the dollar goes to zero and all that. I've been waiting for that my whole life. I thought that was going to happen in 1999, but it turns out the U.S. is still the strongest and richest nation in the world. And as messed up as we are not going to roll over and die just that easily. So all these people who tell you that the dollar's going to fall, don't look for that to happen. But the baby boomer retirement panic is a very real possibility, and you'll know it if you see it. It'll be unmistakable. It'll be like the tsunami hitting the beach. It'll sweep everything with it. If we don't get that, fine, but that's the whole purpose of this analog. It tells us what to expect. Go with it until it stops working. Knowing that this is coming, and we're still way up here, and we've got all this yet to go, what can we do about it? First step is to evaluate your time horizon. If you've still got at least 10, 12 years to wait, you're golden. I mean, you can take it easy. You can go the no risk route if you want. You're still working, just throw X amount of money in the market. And yeah, you may lose 80% of it, but within 10 years or so, at least it should be back to where it was. Typical recovery time is 1 to 3 years. So if we got another year or two in the bear market, so you're talking 2 to 4 years, you'll be back to even where you were before the crash started. If you don't have that kind of time to deal with, if you're nearing retirement or in retirement, if you're in retirement, what the heck are you doing in stocks? You need to be in dividend plays or bonds or something a little bit more secure. But in general, if you have less time, if you can't wait that long, or if you've got money stored up for college education you're going to need sooner than that, you want to keep in mind that you may need to pull that out. Second thing is evaluate your portfolio risk level. Now, what do I mean by your risk level? Well, how much of your overall portfolio is in stocks? You may have some in cash, you may have some in bonds, you may have some in real estate. And if you look at the overall thing and you say, okay, I'm going to lose a big chunk of this, 40, 50% in a bear market, let's say, how does that affect me overall? Is that an acceptable risk level? Can I tolerate that kind of risk level with my stock portion of my portfolio, bearing in mind that real estate's probably going to be falling too? Or do I need to reduce and move some of that money into cash or bonds or some type of interest-bearing security or a dividend stock with risk protection? Step number 3 is to track your portfolio value versus the S&P by percentage. The reason for this is, number 1, you need to get a feel for how your portfolio behaves versus the S&P. It's called beta. For example, if the S&P goes down 2% and your portfolio goes down 4%, it means you have a beta of 2. You're twice as risky as the S&P. And so you need to know that because you may need to either reduce your position or move some of your portfolio into the SPY, which is the S&P 500 tracking stock, so you have less volatility. But if you don't know what's happening, you can wake up one day and say, dang, I used to have 100,000, now I got 20. How did I let that happen? Well, you let that happen by not watching it every day. If you watch it every day, then eventually you can start to take steps to limit those losses. Now, how do you know when to take steps? That leads to number 4, using a risk control trigger. A risk control trigger is something that gives you market buy and sell signals that is not your brain, because your brain, by human nature, is going to make you do all the wrong things. So it can be a moving average crossover. It can be something you read that works really well in an article. It could be a black box system you've paid some money for. Whatever it is, it needs to tell you when to be long and when to be short the market. And it needs to sort of match your frequency as a trader. For example, I don't want more than 4 or 5 signals a year. I don't want to be trying to trade every wiggle. You might want to get in and out more often, which may be advantageous. It may not be. But whatever you use, it should match the number of signals per year, should match your temperament as an investor or trader. Now, that trigger is designed to tell you when to be long or short. Now, what do you do when the trigger says sell? Well, you can do a couple things. Number 1, you can go to cash. You can just sit it out till the trigger says to buy again. Number 2, you can go short. You can use a short ETF so that when the market goes down, your portfolio goes up. Sounds good, doesn't it? I know my portfolio definitely got some advantage today from my short positions. So learn to use short ETFs. And the other thing you can do is, let's say you have a bunch of dividend stocks like I do. And your dividend stocks are going to lose value when the market falls. And of course, the dividend rate will go higher, but you're losing capital. And to prevent that loss, I usually move about 1/3 my dividend portfolio into SDS, which is double short the S&P 500. That way, it's not a precise science, and you need to keep track of it and maybe vary it a little bit. But overall, I find 1/3 tends to be, for the types of dividend stocks I use, and everyone's going to vary, 1/3 for me tends to balance out my portfolio loss fairly well. So as the market goes down, the value of my stocks that are dividend-paying stocks go down, but this is offset by the short ETF going up, and vice versa in the opposite direction. Again, it's not a perfect science, but it keeps me, in the case where I'm going to lose half the value of my portfolio, it'll keep me from losing half the equity in my dividend stocks. So that's the end of today's updates. I'll be doing more updates and taking on different facets of the crash in the other updates. And so if you want to subscribe, go ahead and hit the button so you can catch the other updates as they come out. And if you want to watch the original 2022 crash video, you can click the link there, and that way you'll get to see all of my thinking into why I think 2022 is a perfect time for a crash, and what all the factors are leading into that crash, and where we are along the road to reaching the bottom of that crash. So until the next update, this is ghbond saying control your risk and stay profitable.